Monday, August 16th, 2021, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at this book here, Lords of Finance. And we're going to look at chapter 9 in particular, which is about the gold standard after World War I and the dilemma the major countries had between devaluation or deflation. And I think the major central banking authorities and countries right now in 2021 face the same dilemma. I would highly recommend the book. It's by Liaquat Ahmed, Lords of Finance. I read it quite a few years ago, but I wanted to look into something, and I got caught up in this chapter the other day, and I think it's very interesting. We're going to look at that. Before I go into the subject, just a little bit on Afghanistan. Well, there's an old saying that Afghanistan is the graveyard of empires, and it looks like it's fulfilling that that term, I guess. The other thing I would say about the Biden administration, there's an old saying here in England or in the UK that someone can't even organize a piss up in a brewery. Someone is really incompetent. But I think it's more complicated than that, what's going on in Afghanistan. And I have to say, it's a shame, of course, for the people of Afghanistan, for the Americans and allied troops that have been there for decades, for the American taxpayer as well. It's not only the Biden administration, but all the administrations since Bush the younger have squandered over $2 trillion there. But there's more to it, and I'm not going to go into it. But the other thing I wanted to show you, this is from the Peter Peterson Foundation, and it shows you that the United States spends more on defense than the next 11 countries combined, and that includes China, India, Russia, United Kingdom, Saudi Arabia, Germany, France, Japan, South Korea, Italy, and Australia. So you need to ask yourself what this is really all about. A country that spends more than the next 11 countries on defense can't defeat a country that isn't even on that list over 20 years. So that's all I have to say about that for now. So to Lords of Finance now, and chapter 9, where the author talks about the dilemma that the major warring countries had after the war. And prior to World War I, of course, all these countries were on a gold standard. That meant that their currency had to be backed by a certain proportion of gold. But during World War I, what happened is that they abandoned the gold standard, and their governments issued more currency without the backing of gold. And at the end of World War I, the problem was that they issued so much unbacked currency that they had price inflation, pretty much like we're having now. And the choice was, there were two choices. They could raise rates, interest rates, to deflate the money supply, the currency supply, and get the proportion of gold to the currency they had in circulation to World War I levels. But that would have been very painful. The United States did that. Actually, the New York Fed did raise rates, and the United States was actually in a interesting situation because they actually had a flood of gold that came in. So because of all the material and equipment they provided to the warring factions up until 1917. So they were not in the war. So the U.S. wasn't a gold standard, but they had too much gold, and that caused also a rise in prices because It led to increase in currency supply, the gold supply. So what the New York Fed did is that they raised interest rates to 7% after World War One, and that caused a mini depression in the early 1920, 1921. And the money supply or the currency supplies shrunk, and then the economy picked up again, but there was unemployment. That's the choice. The other country that took the same route as the United States was the UK, but the UK actually was in a different situation in terms of gold. They had not increased their gold holdings. Their gold holdings went down, but their currency supply went up, and they did the same thing. They deflated. They were trying to bring the currency supply down. But the Germans, of course, they kept inflating. And what happened to them is that they had a hyperinflation. The currency collapsed eventually in 1923. So the author goes over what this really means here. And I thought it was a really good example or analogy of what the choice was for these countries. And people might wonder, well, we're not on a gold standard now. What does this matter? Well, yes, we're not on a gold standard, but all the major countries of the world still hold around, let's say, 35,000 metric tons of gold. And that's for a reason. And that's why the Federal Reserve, the Bank of England, all the major central banks are still heavily involved in gold, because de facto gold is still part of the monetary system, even though they don't want people to know. So let's look at this analogy from the author. It says a simple analogy of the choice between deflation and devaluation might be that of the man who has put on weight and is having a hard time fitting into his clothes. He can either choose to lose the weight, that is, deflate. So here it would be to deflate the money supply, credit, currency supply. Or alternatively, accept that his larger waistline is now irreversible and have his clothes altered, that is, to devalue. So in this case, back then it would be to allow the price of gold to go up, to devalue the currency, so revalue the price of gold. Whether to deflate or devalue became the central economic decision of every country after the war. And I know that there's a lot of people out there comparing what's going on now in the world with a war. And I think, unfortunately, this crisis is going to keep going, and they're going to have to keep increasing the currency supply. There's no end in sight to that. And they're going to have to come to some kind of decision about whether they deflate the currency or fiat currency supply, or whether they devalue. I think they will devalue. That will be their choice. It could lead to hyperinflation. It could lead just to very high inflation. The burden of deflation fell on workers, businesses, and borrowers. That of devaluation on savers. So yes, nowadays, of course, very few people save in gold and silver, but they save in fiat currency. So that's why I tell people you need to be out of fiat currency. Of course, that doesn't mean the fiat currency you hold in your bank account for bills, monthly bills. That means the extra fiat currency you've been able to save throughout your life, it will be decimated in the next few years. The fate of the world economy would hinge over the next 2 decades on which path each country took. The United States and Britain took the route of deflation, Germany and France that of devaluation. And now, before I finish and look at the markets, I wanted to show you a chart which I've built up on the Fred website, thanks to John Titus, who did a really great video that I recommend you watch. It's called Larry and Karsten's Excellent Pandemic. And it's all about how QE this time will flow into the private sector, into private deposits, unlike after 2008, where QE flowed into the banking system to bail out Wall Street, but didn't affect private deposits. And by private deposit, he means the deposits that commercial banks create for us, for private businesses, for non-financial institutions. Because the other kind of deposit that we have here is the deposit that the Federal Reserve creates through QE for the banking system. And as you can see here, the vertical axis, that's the deposits of all commercial banks. So that's the deposits that they create for us and other businesses that are not financial businesses. And that prior to September 11, 2019, yes, it was September 11, that's the date when Federal Reserve started bailing out the repo market. Prior to that, you can see that this all commercial banks deposits, it went up no matter what the Fed's balance sheet did, or no matter what the deposits that the Fed created for commercial banks did. But as you can see now, since the Fed started QE again back in September of 2019, and the QE line, I guess, would be the green line. That's the Fed's balance sheet. You notice that the commercial bank deposits, the currency or money, if you want to call it, that they create for us in the private sector, that has followed the QE or the Fed's balance sheet almost exactly the same. It's grown exactly at the same pace. It hasn't continued to grow like it used to do back until 2002. And that's why we're seeing consumer price inflation, and that's why it's not going to end. And this is what shows me that they're going to continue to devalue or inflate the system. They're not going to deflate. And that's why holding gold and silver is more important than ever. If you are a saver, if you're not a saver, yes, you don't have to worry about that. But I thought that was really interesting. I'm going to put that video up in the cards and in the description of this video below. I highly recommend you watch that. Yes, they were right back in 2008 that QE would not create consumer price rises, or what they call inflation. That's because the commercial banks were not matching the amount of QE they were getting through the Fed's QE into the real economy. But as you can see now, that's happening in spades. And it's all to do with BlackRock's plan from August 2019. And I even interviewed him here on this channel recently. And it's called Going the Direct Way. So basically, QE has become helicopter money now. Prior to 2019, QE was bank bailouts, and now it's become bank bailout as well, but also helicopter money. So watch out, savers. So with that, let's quickly look at where the markets are this morning. It's just gone past 9 a.m. London. We've got spot gold at $1774.50. That's down about $5. Range has been $1771 to $1783. Silver is down 22 cents, or just under 1%, at $23.52. Range has been $23.48 to $23.83. To the stock market, the Dow is down 60 points. The NASDAQ 100 futures down 15, S&P futures down 7, the FTSE is down 55 points. To the currency market, yeah, the pound is down slightly at 138.60, almost unchanged. So's the euro, 117.85. The dollar's down versus the yen about 1/4% at 109.38. Dollar's unchanged versus the yuan at 647.72. Aussie dollar is down 0.5% at 73.37 versus the dollar. And the dollar is up 1/4% versus the Canadian dollar at 125.44. WTI crude is down 1.5% at $67. High grade copper is down 1.5% at 431.72. The 10-year yield is down 2.5 basis points at 1.27%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.